Hey everyone, Anthony Venuta here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to be taking a look at the economic landscape here in Canada, inflation, housing, and more importantly, what it means for you in the current higher rate environment. If you have a mortgage, you should be prepared for higher interest rates. Stay tuned, you don't want to miss this. Once again, I want to welcome everyone back to the channel as this week we take an opportunity to look at an analysis of the current economic landscape here in Canada as we just got some of those CPI numbers earlier this week. Today we'll explore some of the intricacies of inflation, the challenges in the housing market, and the importance of planning for mortgage payment increases in the future, depending on what the Bank of Canada does in September or doesn't do. Join us as we dive into these details and provide you some valuable insight to help you navigate some of these complex financial waters. Now, obviously, inflation is a very important conversation for the Bank of Canada and for Canadians. So let's begin by examining the state of inflation in Canada. The Consumer Price Index, or the CPI, rose to 2.8% year over year in June, showing a deceleration from the previous month. However, behind these figures lies an intriguing story. And that story plays on the fact that gasoline prices did have a significant role in influencing the slowdown of the CPI headline inflation number. If we exclude gasoline, headline inflation would have been a notable 4% in June. Furthermore, certain factors made substantial contributions to the overall increase, including elevated grocery prices and mortgage interest costs. And we'll talk a little bit more about that in just a moment. Now, as we dive deeper and take a closer look at these specific components driving up the inflationary trends, what factors are impacting inflation and potentially the Bank of Canada's decision come September. Now, obviously, we need to wait for July's data as well, but they will look at June, July, and they'll see exactly where that trajectory is. But for June, Canadians experienced the highest inflationary impacts in grocery prices and mortgage interest costs. Grocery prices surged by 9.1%, putting significant strain on households. Meanwhile, mortgage interest costs skyrocketed by 30.1%, adding to the overall inflationary pressures for those statistics. Obviously, headline inflation is the key, what the Bank of Canada wants to see come down, but core inflation, stripping of food and energy, is what they're paying close attention to. And as we examine the all items index, excluding food, likewise excluding mortgage interest costs, the index increased by 2%. The significance of these specific factors in driving up inflation. So food and mortgage interest costs are the biggest drivers for headline inflation. Now, let's take a quick look at the factors influencing the most recent monthly changes in those inflation rates. In June, the CPI experienced a slight monthly increase of 0.01%, following a 0.04% gain in May. Notably, transportation and recreation, education and travel were one of the major categories that contributed to the slowdown in headline inflation. While gas prices fell by 21.6% year over year, other areas witnessed contrasting trends. Remember, base year effects year over year, those bigger numbers mixing in with the smaller numbers. For instance, prices for fresh fruit grew faster while cellular services and internet access services declined. However, one constant theme emerged, and that is grocery prices continued to rise with significant increases in meat, bakery products, dairy products, and other food preparation items like restaurants and what those costs are to consumers. Very important numbers for the Bank of Canada. They're talking about sticky inflation in some of those core buckets. Having explored some of those inflation dynamics, I want to take an opportunity and shift our attention to some of the challenges that are being faced in the housing market and what these implications could mean for new mortgage borrowers and existing mortgage borrowers. So, housing market challenges obviously are important aspects for Canadians as we look at payment increases or the potential for further increases to Canadians' mortgage costs. The housing market remains a formidable challenge with rapid increases in housing resale and facing limited supply, driving prices higher than projected. Despite the Bank of Canada's interest rate hikes, the results were not as immediate or potent as expected, with housing prices continuing their upwards trajectory. These escalating prices have had a profound impact on mortgage borrowers. Obviously, fixed rate mortgage holders who purchased earlier in the pandemic may face steep payment increases at renewal in the coming years. Variable rate mortgage or VRM holders have already experienced payment increases and may shoulder significant burdens at renewal depending on where interest rates are headed, as we see the bond market, which is the barometer for fixed rate mortgages, continue to digest the data to prepare for these potential payment shocks. It is crucial for borrowers to explore their options and take the proactive steps. By assessing potential financial impacts, consulting with a mortgage professional, obviously, and considering different interest rate scenarios, borrowers can make informed decisions. Now, financial planners also can provide valuable guidance in evaluating, and elevating clients' net worth, but net worth projection, cash flows, suggesting adjustments, and making some amendments to spending and savings can help Canadians obviously keep more money in their pocket. And by this, just to summarize, what we mean is that over the past few decades, we haven't really supported saving when interest rates are lower, but now as we're starting to see these interest rates rise, there is more available to Canadians who have money, who can park these monies in things such as GICs at higher rates of returns. Now, obviously, speaking to a financial planner about this can help you to make a little bit more money if you find yourself in a position that you have excess money. But obviously, not everybody's there. So let's discuss some practical strategies to mitigate the impact of rising interest rates and ensure that Canadians can remain as financially stable as possible. Now, obviously, mitigating some of these risks are challenging. Not everybody is the same. Not everybody has the same mortgage requirements, financial obligations. It is unique to each individual. So one possible strategy for borrowers is to maybe consider lengthening their mortgage amortization to minimize payment increases. While this option may require passing the new mortgage stress test, it does offer a potential for relief at mortgage renewal time. So some Canadians who might find themselves in a fixed rate mortgage that was significantly lower, the rate was lower than what they might be renewing in today, they may consider looking at their amortization, either extending it back up to 30 years, especially for those Canadians who might have a very small amortization left and are finding it challenging to make their payments in a higher rate environment. But it's important to speak to your mortgage professional and have a conversation about those options. And in your particular situation, especially when it comes to variable rate mortgage holders, especially those who may have fallen behind on their principal repayment schedule or their amortization, they should strive to try and pay as close to the adjusted payment as possible. Even partial principal payments can make a significant difference. So what does all that mean? Well, if you're on a variable rate mortgage with an adjustable payment, well, it's important to understand that your payments will automatically go up when the Bank of Canada increases policy rate. But it also means that if and when the Bank of Canada decides that it's time to cut rates, well, your payment will automatically adjust downwards, as opposed to Canadians who are on a trigger rate or static payment mortgage. If they get into a static payment mortgage today, their payment gets locked in. And if interest rates do end up dropping at some point, well, then that payment still remains the same, just more money goes towards interest than principal. So it's important to understand that as well. Now, keeping in mind that if you are on a static mortgage or one of those trigger rate mortgages, that if you were looking to make a move, or refinance, or restructure, you would be required to bring that amortization back in line to 25 or 30 years, depending if you're refinancing or if you're switching to a different lender. There are so many things that you need to consider if you're planning to maybe lock in, switch lenders, understanding your penalties, as this is a time right now where a lot of variable rate mortgages, even with a 3-month penalty to get out, are much higher than some Canadians who have a fixed rate mortgage. And we'll talk a little bit more about that on another episode. So make sure you like, share, and subscribe to the channel. Leave your comments below. Let us know your thoughts. Now, in the largest context, addressing the challenges in the housing market requires a comprehensive measure involving government policies, zoning regulations, incentives for construction, and efforts to increase affordable housing options. By tackling these issues, we can alleviate housing affordability crisis, address regional disparities, and of course, mitigate economic impacts. Now, what does that mean? Like talking about the government, the responsibility of the federal, the provincial, and the municipal government, something we've talked about on the channel. And I want to just quickly talk a little bit about our Minister of Housing here in Canada, who did do an op-ed in a local newspaper, and this is the tweet that he broadcast. Obviously, it's important to understand that this is party politics. He's criticizing another party for their agenda, but in my opinion, yet the current administration is not providing the adequate resources or the adequate function of affordable housing by helping us improve it. Now, what I mean by that is we don't want to get into party politics. We don't want to say that this side or that side of the aisle is better, but I think it should be a bipartisan issue. Both, all parties, all government bodies should be focusing on housing unanimously. Obviously, all together, it should be an entire government mandate to make sure that we can bring in all these new to Canada individuals, which we so desperately need, provide them with affordable opportunities, and make sure that rents don't skyrocket, because there is a correlation between higher interest rates and, yes, higher rents. Now, I want to take an opportunity and, before we conclude the analysis, just to leave some thoughts and opinions of my own with our viewers for some comment and feedback in the comments sections below. But it's important to understand a few different things. I believe the Bank of Canada, with all the current rate hikes, obviously is sort of hand-tying or holding Canadians in their homes. Because of the higher stress test rules as a result of higher variable rate and fixed rate mortgages, Canadians who may have otherwise wanted to upsize or even downsize potentially could not qualify for the existing mortgage that they may have, or the new money that they may need to take on if they were to port their mortgage. And just for those of you who may not be aware, a port is when you're taking your existing mortgage at the current term and rate and taking it over to a new property, providing you qualify under the current guidelines. That is the key. You can't just take the mortgage over, you have to requalify for the old money and the new money on that mortgage. And many Canadians with higher interest rates tipping, generally around the 6% mark, depending on what type of product you're taking, well, many of them may not want to stomach that extra money. And some Canadians who don't have a mortgage are definitely not looking at getting into a mortgage. There are so many different components that could be limiting the amount of homes that we see coming to the market. Let's add to that the fact that there are less new construction starts. They're sort of falling off a cliff right now. This basically leads us to a future problem that we should be paying very close attention to, because we are going to be talking about housing affordability probably for the next decade if the governments and the powers that be do not actually do something to tackle the housing supply crisis, at least in my opinion. Let us know in the comments sections below. But as we conclude our analysis, it is evident that borrowers in Canada must plan ahead for significant payment increases, obviously even at renewal time. Speaking to a mortgage professional about that, and their renewal should help keep thousands of dollars in your pocket by understanding the inflation dynamics, challenges in the housing market, and adopting proactive strategies. Borrowers can help navigate these financial waters with confidence, and obviously depending on how you think the Bank of Canada will react on September will obviously impact your decision on what you're doing with your mortgage or your real estate transaction. So we encourage you to seek out professional guidance from mortgage brokers, financial planners, or lenders to assess your specific situation and plan for these potential increases, as we are uncertain if the Bank of Canada will or will not increase in September and onwards. Remember, informed decision making is a proactive action and will empower you to secure a stable financial future. We'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Remember, if you're not subscribed to the channel, please do so. Don't forget to like and share the video with a friend. Let us know in the comment sections below what you think. But have a great Friday, and we'll see you next week.